All right, today we're diving deep into Elevance Health, ticker symbol ELV. Now, this is one of the absolute biggest players in American healthcare, but its stock has been hitting some serious headwinds lately. So the big question is this a hidden gem just waiting to be discovered, or is it a warning sign of bigger trouble ahead? So, this is the central puzzle we're trying to solve. You've got this nearly $200 billion behemoth of a company, and its stock has taken a noticeable step back. So is this just a temporary stumble, creating a great buying opportunity for us? Or is it a trap waiting to spring on investors? That's what we're here to figure out. Okay, first things first. To really get what's going on with Elevance, we need to appreciate the sheer scale of this company, and then zero in on the specific dilemma that it's facing right now. So who exactly is Elevance Health? Well, you might actually know them by their old name, Anthem. We're talking about a true titan in the U.S. health insurance world. And get this, they are the single largest provider of Blue Cross and Blue Shield plans with a massive footprint covering 14 states. And when I say titan, I'm not kidding. Just look at that number. That's almost $199 billion in revenue over the last year alone. That kind of scale is just massive, even for the healthcare industry. It means they're managing the healthcare journey for tens of millions of people. But here's the catch. Despite all that cash flowing through the company, the stock has been under some real pressure. It's pulled back to the neighborhood of $286 a share. And the reason? The company itself put out a pretty cautious forecast for the year 2026. And, that's all it takes to make Wall Street nervous. Okay, so before we can really analyze those challenges, we need to understand how this massive company actually makes its money. Let's pop the hood and take a look at the business engine that drives everything. The business really breaks down into two main parts. The lion's share of the money comes from its core health benefits division. But the piece you really want to watch, the one that's super interesting, is the smaller segment called Carelon, which is really the company's big bet on future growth. So let's quickly break those down. Health benefits is exactly what it sounds like. Your traditional insurance plans for companies, individuals, and big government programs like Medicare and Medicaid. Carelon, on the other hand, is a different animal. It's focused on services, things like pharmacy benefits, behavioral health, and managing care for really complex health conditions. It's their big move to diversify beyond just collecting insurance premiums.
All right, so now we get how they operate. Let's dig into the big issue, the elephant in the room. What exactly is causing all this anxiety about the year 2026?
The whole problem really comes down to a stark contrast between 2 years. You see, the company had a really strong 2025, but then it came out with its own forecast for 2026, and it showed a significant step backward. That's what spooked investors. Let's look at the numbers. So here's our starting point. In 2025, Elevance delivered an impressive adjusted earnings per share of $30.29. That is a fantastic result, showing really solid growth and execution. And now, here's the problem. The company guided that for 2026, it expects adjusted earnings of at least $25.50. You can just see that drop right there. I mean, going from over $30 down to the mid-20s is a major change in direction.
So what's causing this dip? Well, to their credit, management was very clear about it. They're basically getting hit from all sides. There are pressures from Medicaid enrollment, rising costs in their Medicare Advantage business, a slight dip expected from the Carelon segment, and even lower income from their investments. It's kind of a perfect storm of challenges hitting all at once.
But that's the bad news. That's not the end of the story. This is the turning point, because management isn't just sitting back and taking it. They have a very specific plan to navigate these challenges and get the company back on track. Management's own words tell the story perfectly. They framed 2026 not as a failure, but as a year of execution and repositioning. You see what they're doing? The whole idea is to take a short-term hit in order to set the company up for much greater long-term strength.
So what does this plan actually look like? Well, it's a three-pronged strategy. First, and this is the big one, they have to fix the profitability in their Medicare business. Second, they need to stabilize the Medicaid segment, which they think will hit its low point in 2026. And third, they're going to keep investing in the long-term growth of their Carelon services platform.
And what makes this plan feel credible is just how specific and measurable it is. They aren't just promising to do better. No, they are explicitly targeting a 2 percentage point improvement in their Medicare Advantage margins. That gives us, as investors, a very clear benchmark to watch. So now let's get to the climax of our analysis. Let's see how this whole recovery plan connects back to the stock price. With all of this factored in, you have to ask, is Elevance Health actually undervalued right now? When you look at the valuation, things get really interesting. On a price-to-earnings basis, Elevance is trading at a multiple of around 11.3. The rest of the healthcare sector, the average is often way up over 20. And its price-to-sales ratio is incredibly low at about 0.3. I mean, these numbers are practically screaming discount. This chart just makes that valuation gap crystal clear. You can see just how much lower Elevance Health's PE ratio is compared to the average for its peer group. The market is pricing this company very, very differently than the rest of the sector. So, what could this discount mean in terms of potential? Well, based on what the average analyst thinks, the implied upside from current levels is somewhere in the ballpark of 30 to 40%. That is a substantial potential return if management's recovery plan actually works. And this really is the core investment thesis in a nutshell. It's what's known as a cyclical discount. The whole idea is that you've got this high-quality, industry-leading company that's being priced based on its temporary, short-term problems, while the market might be totally overlooking its long-term strength and recovery potential. Of course, no investment is a sure thing. To be balanced, we have to consider what could go wrong. I mean, persistently high medical costs could really hurt their margins. Changes in government policy for Medicare and Medicaid are a constant risk. And, of course, the healthcare industry is just intensely competitive. And that leaves us with our final crucial question. It is crystal clear the market has seen the headwinds coming in 2026 and has priced them into the stock. But in doing so, has it completely missed the potential for a strong recovery in 2027 and beyond? That right there, that is the multi-billion-dollar question for anyone looking at Elevance Health today.